Hey, Dustin Tibbetts with Passport to Wall Street, and today we're going to cover our stock of the week, trades of the week. I've gone back and looked at a few of them. They have done quite well with our previous suggestions, and we're going to move on to another one this week, and with a few pretty interesting sort of tidbits to pass along here. We're going to focus on using options for this trade as well. So this fits both the short-term trader looking for that quicker profit, as well as maybe someone a little bit more long-term that might not mind owning some shares on this particular stock. So with that in mind, let's go over to the charts and take a look. The symbol that we're going to look at today is BMY, Bristol Myers Squibb is the name of the company. And if we take a look here, the stock has fallen quite a bit over the last few weeks. While the markets have stopped at the 200-day moving average and taken a bit of a break, BMY has continued to fall a little bit lower. Now, what we're looking for here is this to either snap back a little bit or go sideways. Now we're picking on this individual stock because by using certain options, we're able to get a credit, a premium to us that's worthwhile. So let's take a look. The stock is trading at 58.84. Now what we'd like to do is have an average cost of around 56. And the reason we pick 56 is because if you go from this previous high all the way down to 56, that is a 20% decline, almost perfectly on the dot. That is typically known as a support area, especially when there's a decline so rapidly like we've seen just over the last couple months. So the game plan is to either A, wait for the stock to fall down there, which may or may not happen, or we can go simply sell a put. Whether you're going to use a cash secured put or you're going to use margin for this is fine. We're going to look to have an average cost of 56. So how do we do that? We know we want to be there at that 20% level. If we go to the May expiration, we have a handful of choices. Let me reduce this down a little bit. We know the stock's trading at 58.84, basically right in this little window right here. Now what's interesting is if we sell a 57.50 put. Now I'm going to assume by the time you watch this that this stock will have bounced a little bit. So we're going to pretend that the price is $1.50. If you get in before or if the stock stays here, maybe you do get a little bit better premium. But if we can get at least $1.50 for this put that we sell here, well now we know that that brings our average cost down to 56, which is exactly where we'd like to have it. Of course, we do not want the stock to fall to 56, but think of it this way. If the stock falls down here and we get assigned on our put, then we would have an average cost of 56. It's kind of like we got a 20% discount on the price of the stock. So while we prefer that this either continues sideways or starts to bounce from here, if it does fall, then that's okay too. So it's kind of not really a win-win on each side, but still pretty cool. Now, we won't hold the position until we make the full $1.50. The goal would be to make about, if we could get about 80 cents, 85 cents, somewhere in there, that would be perfect. Help pay for some commissions and get us about a 50% profit. So that is the play, the 57.50 puts. We're going to look to sell those, and we hope that the stock either bounces now or moves sideways, one or the other. If you can get at least $1.50 for those puts, it gives you an average cost right at 20% discount. That's a really nice average cost, but preferably we'd like to see the stock bounce. So very interesting play for us this week, a very interesting opportunity for us to participate. So I hope you enjoyed. We will continue this going here. Let us know what you think, and we'll talk soon.